The sun is shining, the birds are chirping, and Bitcoin is up. Does that mean the bottom is in? Maybe, maybe not. But one thing is for certain, there is light at the end of the tunnel.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Guten Tag, buenos dias, morgen, and welcome to episode 277 of the Bitcoin Bulletin Podcast. As usual, I am your host, Chris, and I am coming to you from the Bitcoin Bulletin studio on Florida's absolutely gorgeous Space Coast. We are plowing right ahead towards two major milestones as we close in on the 5th anniversary of the Bitcoin Bulletin Podcast and the end of the bear market. Nobody knows exactly when the bear market will end, but if history rhymes, it is definitely getting close. We, of course, will only know what the bottom was in hindsight, but we do know exactly when the next halving will occur, and that will happen at exactly block 1,050,000. And depending on how fast blocks come in, that will be sometime around April 14th, 2028. And of course, then it all begins again. Plebs, I am incredibly optimistic today. Not just because Bitcoin is up a bit, I saw it above 65,000 just a little while before showtime, but because even if the price goes back down, we are getting ever closer to the next halving, and by extension, the end of the bear market, one way or another. As Adam Meister so famously likes to put it, one day closer to an all-time high. All right, I'm getting ahead of myself as usual, but of course we do have a lot to talk about today. But before we get into all of that, let's take a moment for our customary look at Bitcoin's vital statistics. At the time of this recording, we are at a block height of 958,205, and Bitcoin is ringing in at a US dollar price of $64,850 per Bitcoin, just a little under 65,000, a number that I definitely saw we breached a little while ago this afternoon. The current price of Bitcoin, however, means that we will still score 1,542 Satoshis for every dollar that we convert into Bitcoin today. That's exciting. Remember, the $100,000 Bitcoin mark is the point where we go under 1,000 Satoshis per dollar. So we're going to get significantly more than that because Bitcoin's about 50% off of its all-time high still. And that means we're in the accumulation phase. Bitcoin's current price gives it a market cap of 1.3 trillion US dollars, up rather nicely from last week's 1.24 trillion. I've postulated the last several episodes now that, people always talk about dollar prices of Bitcoin in terms of this is the last time we'll ever see Bitcoin below 20,000, or the last time we'll ever see Bitcoin below 60,000, or the last time we'll ever see Bitcoin below 100,000. But it will be interesting if this was the last time that we ever saw Bitcoin below $1 trillion market cap. That would be significant. I mean, we're healthily above that now. Bitcoin would have to drop quite a bit to drop below it, and that's possible, but $1 trillion was a significant milestone. Crossing $1 trillion meant that Bitcoin was an asset to be reckoned with. It put it solidly amongst the largest assets that you could invest in, and it would be interesting to see if this cycle was the last time we ever saw a market cap below 1 trillion. Certainly looking like that's a possibility, with the market cap bringing in at a healthy 1.3 trillion as we speak. For those of you who continue to value your wealth in shiny yellow rocks, it will currently cost you 15.4 ounces of gold to purchase just one Bitcoin. That is 0.7 ounces of gold more than just last DCA Wednesday. Of course, gold had a heck of a run compared to a lot of assets, something that Peter Schiff likes to point out. But when you zoom out, priced in Bitcoin, the price of gold has continued to trend down and to the right. And right now, if you're a gold bug, you have the opportunity to purchase one Bitcoin for just under 2 pounds of gold. Sorry, just under 1 pound of gold. Something that will not be the case when the bear market is over and we get back to our regularly scheduled bull run. For those of you who value your wealth in something a little tastier than trying to bite into a shiny piece of metal, one Bitcoin will currently purchase you a staggering 3,626 large pepperoni pizzas from Papa John's. Pretty impressive when you consider that it was just 16 years ago that Laszlo made the very first real-world Bitcoin transaction when he paid an astounding 10,000 Bitcoin to purchase just 2 pizzas from Papa John's. To put that into further perspective, if you had 1 Bitcoin's worth of value and you tried to spend it by purchasing 1 Bitcoin a day every day, it would take you almost 10 years to do so. Just a few days short of 10 years at the current price of Bitcoin and the current price of a large pepperoni pizza at Papa John's. So a fun metric that I like to follow. But that metric that you know has been my favorite metric the entire history of this podcast, that is Bitcoin's 24-hour average transaction rate, is blazing right along. The Bitcoin network is currently settling an incredible 6.35 transactions per second on chain. That's down a little bit from the 7.39 transactions per second last week, but still really impressive on-chain activity. And of course, that doesn't take into account those second layers like predominantly Lightning, which is every time I've used Bitcoin recently has been on the Lightning network. And, whatever second layer solution we might not even know of yet, something else better than Lightning might come along, or a third layer or even a fourth layer solution. None of those are accounted in that base on-chain transaction figure of 6.35 transactions per second. And putting that in perspective, when we first began this podcast about 5 years ago now, we were happy to see more than 3.14 or 3.15 transactions per second on chain. And that was with Lightning just as basically a beta technology that wasn't really in use yet. So more than double the on-chain activity that we saw at the beginning when we first started this podcast 5 years ago. And of course, incredibly robust Lightning Network activity. And I've often said many, many times in this podcast that I believe in the not too distant future, you and I, plebs, we won't be settling our transactions on chain. Only governments or banks or maybe Michael Saylor will be moving Bitcoin around on chain. But for the average pleb, we're going to have our stash and we're going to have a Lightning wallet or whatever the next solution that is discovered is. And we're going to be transacting peer-to-peer, on that second or third layer solution. So pretty incredible that Bitcoin is able to settle that much activity just on chain. Speaking of all that on-chain activity, the mempools, they're a little, it depends on where you look. Clark Moody's dashboard actually has 50 transactions fewer in it than it did last week. Currently, there are 2,907 transactions in Clark Moody's dashboard, but mempool.space and the mempools that run more liberal mempool settings that include all of those controversial, not economic transactions, the spam transactions, the ordinals, the inscriptions, the JPEGs, the whatever people are encoding onto the Bitcoin blockchain. Those transactions are up about 6,000 transactions with 99,396 transactions pending in mempool.space's mempool, for example. So think about that. 2,900 transactions versus 99,396 transactions. We're talking basically 96,000 spam transactions on the Bitcoin network. Vastly more than the 907 mostly economic transactions. So that's a debate that's currently heating up. The core V-Knots debate and the BIP 110 activation that's about a month away from activating, if it activates or doesn't activate. BIP 110, of course, an attempt to throttle those spam transactions, to throttle non-monetary uses of Bitcoin. Something that has been very, very controversial on Bitcoin Twitter recently. But I guess we'll know in just a couple of weeks how that plays out. But in the meantime, relatively robust on-chain activity and a heckload of non-monetary transactions pending to be written to blocks. Despite all of that activity, it is still reasonably cheap to use Bitcoin as money or to write a spam transaction to the blockchain. If you have a high priority transaction that you need to guarantee is written to the very next block, both fee estimators I'm looking at estimate a fee of 3 sats per VByte to guarantee that happens. That might be a bit of an overreaction because the last block took a little over 20 minutes to come in, so about double, the normal 10-minute per block average, and as a result, those fee estimators tend to ratchet that estimated fee up. But still, even if that's the case, 3 sats per VByte, when you take into account the average size of the average on-chain transaction, multiply that by Bitcoin's current price, we're talking just 23 cents in US dollar terms. Not even a quarter of a dollar to wield the most powerful financial technology ever discovered. Of course, if you have a little while to wait, one sat per VByte transactions should clear within a day. Looking back 2 blocks prior to the last one, both of those included fees of less than half a Satoshi per VByte. So reasonable to assume that 1 sat per VByte transactions would clear relatively quickly. And if you are sending a spam transaction, mempool.space is saying that a no priority transaction can include a fee as low as 0.2 sats per VByte. So despite the fact there are a lot of spam transactions clogging up the mempool out there, transactions are still getting written to those blocks in a timely manner and relatively inexpensive. And that is cool to see. Bitcoin had another downward mining difficulty adjustment since the last episode. Mining was decreased by about 5% since the last episode of the Bitcoin Bulletin Podcast. Mining difficulty, as you probably know, is adjusted every 2016 blocks, which works out to about once every 2 weeks, with the goal of keeping blocks coming in at an average of once every 10 minutes. If they're coming in too slow, which was obviously the case, Bitcoin mining difficulty is relaxed a little bit to speed them up. And if they're coming in too fast, which is usually the case because, like the price of Bitcoin going up and to the right, if you zoom out, despite the fact we have bear markets, we continue up and to the right in general. And the same has been the case with the amount of computing power securing the network. While there have been periods of time when the hash rate securing the network has decreased, in general, that's been up and to the right. And so usually we're looking at difficulty increases. We are now 1,411 blocks away from the next mining difficulty adjustment. And depending where you look, that is in fact going to be another increase of about 3.2%. So making up more than half of the decrease we just had. Of course, it's too soon to tell. All that depends on how fast those blocks come in the next 10 days. If blocks continue to come in fast, we'll see an increase. If they slow down a little bit, maybe less of an increase. If they slow down a lot, maybe another decrease. But currently, blocks have been averaging 9 minutes and 43 seconds since the difficulty change. And of course, that is faster than once every 10 minutes. So hence the forecast mining difficulty increase. The 90-day estimate of hash rate securing the Bitcoin network is estimated to be 944.9 exahash, down a little bit from last week when it was estimated to be 951.4 exahash. But again, to put that into perspective, when we did our first episode of the Bitcoin Bulletin Podcast, network hash rate was estimated to be 85 to 90 exahash. So we've seen more than a 10x increase in network security in just under 5 years of the Bitcoin Bulletin Podcast. And plebs, when we first started, Bitcoin was already the most secure computer network in existence. And that was, with just 85 to 90 exahash. That was already inconceivably expensive and inconceivably impossible to rewrite the Bitcoin blockchain then. And of course, it's 10 times more difficult where we stand now. All right. Real quick, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 apps such as Fountain. Podcasting 2.0 is a Bitcoin native way to listen to podcasts, and as such, it allows you to contribute value back to this podcast at something that you determine by either streaming sats as you listen or by what tends to be most people's favorite method, my favorite method, and that is by sending a boost. And of course, a boost is a shout out. It's a message where you reach out and say hi to the podcast, announce something important that might be going on in your community or in your life, or say whatever you want, really. But because that shout out is a Lightning transaction, you are sending value back to the podcast in the form of Satoshis. And when we do receive those boosts, we read them on the next episode. On to the news. Well, the big news yesterday was that inflation, officially anyway, is not quite as bad as it was expected to be. With Yahoo Finance running the headline, inflation cooled in June, with prices dropping 0.4% month over month, CPI data. The article goes on to say prices fell 0.4% month over month and rose 3.5% year over year in June, according to the latest Consumer Price Index survey. Core CPI, which excludes food and energy costs, remained flat at 0.0% monthly and rose 2.6% yearly. Of course, CPI is a completely made up and manipulated statistic. They basically have a long and storied history of changing what is in their basket of goods. For example, when steak got too expensive, they would substitute ground beef and say, ground beef is actually cheaper than steak, and therefore we actually saw inflation decrease, yada, yada, yada. It was, Mark Twain who said there are three types of lies, damn lies, and statistics. And if he had known about CPI or core CPI, he probably would have gone and said there are four types of lies, damn lies, statistics, and really, really egregious statistics like CPI. For example, if you've been shopping, you probably spent more money this month than you did last month, whereas officially your grocery bill should have gotten 0.4% cheaper month over month. Larry Lepard, one of our favorite gold bugs, who is also a Bitcoiner, put this into perspective, tweeting yesterday, My, a cool CPI number. What a gift to Kevin. I'm shocked. Of course, Larry Lepard, with his book, The Big Print, has been predicting that the Fed is going to do whatever it takes to cut rates because they need to cut interest rates to finance the debt. They need to print money to prop up the economy. And what he's inferring there is that, shockingly, the CPI is officially down. We had a cool CPI number, so that's going to allow them to get on with rate cutting. And of course, there is plenty of precedent with each of the so-called big prints getting bigger and bigger. You remember just a few years ago during the COVID era, we saw the largest increase in U.S. money supply in modern history, using the figure M2, with M2 increasing from about 15.5 trillion at the beginning of COVID to 20.7 trillion by the end of 2021. That was an increase of about 35% in nominal dollars. And of course, that dwarfed the previous big print, which was the great financial crisis, the housing crisis, the savings and loan crisis, the savings and loan crisis, the banking crisis of 2008, where we had the big bailout. And then M2 grew by about 11%. So we've seen these bailouts, these needs to print, to prop up the economy, to protect the current financial system, the fiat system, increasing, more than doubling from the great financial crisis to the COVID pump. So make of that what you will. Bitcoin for Freedom on X, his handle at BTC_for_freedom, put the COVID money era printing into perspective in a way that I think we should take warning from and take heed about what is potentially to come, when he tweeted on Saturday, "Imagine working 40 years, skipping vacations, driving used cars, saying next year, and then one man prints in 24 months what took your country a century to earn. You didn't lose money, you lost decades." And plebs, this of course is what Bitcoin is all about. Bitcoin was created in response to the money printer. The headline referencing the great financial crisis, the chancellor on brink for second bailout for banks, is even encoded in the very first block, the so-called Genesis block. So we know it is coming, and we already have the tool to preserve our time. We have the lifeboat, or as Christine Lagarde put it famously, the escape hatch, in Bitcoin, of course. We often say you're not too late when referring to Bitcoin's price, but most importantly, you're not too late to protect your family from this all, as Larry Lepard refers to it, the big print, the looming expansion of the money supply, the printing your savings, your family's savings, or those hours of your life that you traded for money, printing them away, melting that ice cube, as Michael Saylor referred to it so many times. But on to the news, and we didn't lead off with price this time, which is unusual because, as often price is the news and the news is the price. And we certainly have price action to talk about with the price of Bitcoin recovering from a capitulation to as low as $58,000 in late June to, well, I saw it trade above 65,000 this afternoon. So the market appears to be recovering, at least in the short term. Bitcoin briefly dropped to I said as low as $58,000 in June and then climbed back into the mid 60s where it is currently. This recovery is particularly notable because it comes despite continued uncertainty surrounding interest rates in the global markets. Of course, we got a little more insight into what might happen with Fed interest rates with the CPI print yesterday, the cooler CPI numbers giving them cover for cutting those rates, or at least not increasing them. But historically, Bitcoin often experiences periods of maximum pessimism right before resuming its longer-term trend. That's the capitulation phase that I've often talked about. The big question, of course, now remains whether this was simply another bear market rally, and if we see another sell-off, or if the June lows may ultimately prove to be the cycle bottom. It's been my opinion that the 4-year cycle is, in fact, still intact. And, if that is the case, and if history continues to rhyme, then we wouldn't expect the bottom to be in quite yet. We'd expect another leg down and the bottom to come in sometime around maybe October. But there have been differences each cycle. For example, Bitcoin set a brand new all-time high before the halving for the first time ever this time around. And of course, the last bear market was the first time Bitcoin had ever plunged below its previous all-time high. After setting a new time high, Bitcoin had never gone below whatever the previous all-time high was. So each cycle certainly has its distinct differences. And even though they may rhyme overall, it's why we say history doesn't repeat, but it rhymes. So as always, volatility remains high, but Bitcoin bulls are undoubtedly feeling much better tonight than they were just a few weeks ago. And speaking of buyers, another encouraging development for Bitcoin bulls is the return of positive flows into spot Bitcoin ETFs. The spot Bitcoin ETFs saw $221.7 million of inflows on July 2nd, ending a brutal 10-day outflow streak that had seen roughly $2.7 billion leave the ETFs. Over the first week of July, the ETFs subsequently attracted roughly $510 million over just 3 trading sessions, suggesting institutions were buying the dip. And of course, the week ending July 10th posted approximately $197 million of net inflows into the ETFs. And since the ETFs launched in January of 2026, we've now seen a cumulative net inflow into US spot Bitcoin ETFs of more than $50 billion US dollars, which you've got to admit is an astonishing figure considering these products are only about 2.5 years old now. Collectively, the ETFs now hold over 1 million Bitcoin, meaning these products alone control a meaningful percentage of the total supply of Bitcoin, the total supply of Bitcoin in circulation, and the total supply being capped at 21 million Bitcoin that will ever exist. You combine that with corporate treasuries and governments, and the amount of Bitcoin that is effectively locked away, well, it continues to rise. In fact, nearly 21% of the Bitcoin supply is now locked up by ETFs, corporate treasuries, and nation states, etc. According to current estimates, more than 4.19 million of the 21 million Bitcoin total supply are effectively removed from active circulation as a result. One of the most underappreciated stories in Bitcoin right now is, it's the continued reduction in that available supply, not just the total supply, but the supply that's available for trading. An increasing percentage of all Bitcoin ever mined is now being held by those long-term investors like the ETFs and the public companies and governments and other entities that we just spoke about. Entities that have little intention of selling Bitcoin anytime soon. They're less likely to panic sell like the normies that buy their first Bitcoin right before the all-time high and then sell for a loss. When more coins move into those strong hands, fewer coins remain available on exchanges for new buyers. This tightening of supply has historically created the conditions for significant price appreciation when demand eventually increases. It's all about supply and demand. And as the saying goes, there are 21 million Bitcoin, but there may be far fewer than that actually available for purchase. So the supply shock thesis remains very much alive. And speaking of corporate treasuries, this marks the second week in a row that Michael Saylor's strategy has focused on accumulating cash to support its dividend yields instead of stacking Bitcoin. Of course, after actually selling a couple thousand Bitcoin 3 weeks ago. Michael Saylor tweeted on Monday, "Strategy has increased its US dollar reserve by $450 million. As of 7/12/2026, we hodl 843,775 Bitcoin in our BTC reserves and about $3 billion in our USD reserves." So not selling any Bitcoin, but at the moment, but bulking up on cash to make sure they can cover those dividends. For example, that STRC or Stretch, that promises now 12% dividend on its par value of $100 a share. So Michael Saylor definitely taking moves to shore up his other products, but not necessarily giving up on his. Definitely not giving up on his Bitcoin strategy. I mean, they still hold 843,000 Bitcoin, making them definitely one of the largest holders of Bitcoin there is. Speaking of Saylor, Yahoo Finance read the headline this afternoon, "Bitcoin adoption by major banks accelerating, but still early," says Michael Saylor as new index ranks JP Morgan, Goldman Sachs, and others. The article goes on to say, Michael Saylor introduced on Monday the, quote, Bitcoin Banking Adoption Index developed by Strategy, which evaluates the level of Bitcoin adoption among leading banks and financial institutions. Bitcoin adoption is in the early stages, says Saylor. The index, first revealed by Strategy CEO Phong Le on Twitter, or X, scores top institutions such as Fidelity at 71%, Goldman Sachs Group Inc. at 45%, and JP Morgan Chase Company at 43%, across categories including trading, custody, exchange-traded products, stablecoins, blockchain products, margin, and leadership. The overall adoption was at 32%. So a new metric by Michael Saylor's Strategy to rate Bitcoin adoption, or blockchain and stablecoin adoption, I guess, is netted in there. But the point being, Bitcoin changes. It changes you. It changes. It's going to change Wall Street. It is changing Wall Street. It's changing the entire financial system as it takes over the financial system. And Michael Saylor is attempting to introduce a metric to track that and to give that a score. Speaking of treasury companies, well, this is kind of a new twist. According to a report by Bitcoin Magazine, and I don't like to promote them because I believe they're actually a net negative for Bitcoin, my personal opinion. But according to Bitcoin Magazine, investment strategist and electrical engineer and now best-selling author Lynn Alden has announced, well, her twist on the Bitcoin treasury company, posting on X today. Just in, Lynn Alden's Orange Juice raises $40 million to launch a permanent capital holding company backed by a BTC treasury, with quoting Lynn Alden saying, "It's a company that acquires, improves, and permanently holds cash-flowing businesses backed by a Bitcoin treasury." So I've heard Lynn Alden speak about this a couple of times, and a lot of people are not fans of the so-called Bitcoin treasuries, and neither is she. She wants to see companies hold Bitcoin, not companies exist for the sake of holding Bitcoin, but actual profitable companies that also hold Bitcoin on their balance sheet. And this new Orange Juice apparently appears to be targeted at promoting that, or at least capitalizing on that. So interesting to see what comes of Lynn Alden's Orange Juice. One last item I want to touch on before we move on to our dollar cost average segment is I've seen a lot of renewed interest in Bitcoin mining recently on X. And this is something that it's been consistent, listening to podcasts, etc. There are a lot of people talking about a lot of neat products out there, from the small lottery miners like the bid axes, to ways to heat your house if you live somewhere where it's cold, or at least cold in the winter, by using the heat generated by Bitcoin mining to heat your home while also earning Bitcoin. And all of those are pretty neat. And I have a couple of the single terahash lottery miners myself. I mean, that's fun. I don't expect to ever mine a block, but it's cool to think that I can, potentially, that the chances are better than buying a Powerball ticket, for example. But for those that are so inclined to get into Bitcoin mining, I noticed people talking about a couple of different Bitcoin mining options. And the one I noticed most recently was a 30 terahash miner that cost about $650. And that struck me as really expensive. Not just because you'll never make back that $650 mining at 30 terahashes, but because we're at the point again where miners are starting to dump some of their equipment. And as the result, things are getting really expensive. And this isn't the first time we saw this. We saw miners in the past being sold, old Antminer S7s being sold for the scrap value of the aluminum. During, of course, the China mining ban, we saw Antminer S9s going for as low as $30 a piece at the depth of the China mining ban during that bear market. And those were miners that have been selling for, $1,200 to $1,500 at the peak, going for as low as, $30 to $50. And apparently that sort of thing is happening again, because I was searching on Amazon for an example, and I found this listing, for example, an Amazon renewed. So Amazon is getting into renewing miners. As you can buy renewed electronics on Amazon all the time. Apparently the same is for miners, but this particular listing was for an S19 Pro, which comes in at 100 terahash. And that was listed for just $499. New, those S9 Pros were in the thousands of dollars. I think over $3,000 at the peak. So people are out there contemplating spending $650 for 30 terahash. Maybe look a little smarter, because you can pick up some pretty good used mining equipment now for a lot cheaper. More than 3 times the mining power for $150 less than the miner that I saw being discussed on X just last night. All right, on to our DCA segment. DCA, of course, is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. And this is something we've been exploring since almost the very first episode. It was the second episode of the Bitcoin Bulletin Podcast. I decided to start doing dollar cost averaging on air to explore this thesis, this hypothesis, this tactic for acquiring Bitcoin. And at the time, and still through today, we set our equal portion at a humble $20, and we chose weekly for our regular interval. Of course, these are both you do you things. You choose an amount that you think is appropriate for you and an interval that you feel is appropriate for you. But I chose $20 a week because I wanted to show, first of all, that it's not too late to get off zero, even if you have very modest means. And I chose weekly because, well, that's a very common interval for people when they do their investments, and it works out really nicely for a weekly podcast. Today is going to mark our 260th DCA Wednesday. In just days, we will have our 5-year anniversary of the first Bitcoin Bulletin Podcast. The Bitcoin Bulletin Podcast debuted on Sunday, July 25th, 2021, and we did our first dollar cost average Wednesday episode just 3 days later on July 28th, 2021. And since that time, we've stacked $20 worth of Bitcoin every Wednesday. There have already been 258 Wednesdays since then. So in those 258 previous Wednesdays, we converted at just $20 a week, a total of $5,180 now, into a rather impressive stack of 12,036,862 Satoshis. For those of you who are fuzzy on the math, there are 100 million Satoshis in every Bitcoin, so 12 million sats is 0.12 Bitcoin, which is pretty impressive considering we've been stacking just $20 a week. And considering we've been just ignoring the price and plugging away regardless. And along those lines, doing so achieved not only an impressive stack of more than 0.12 Bitcoin, but a reasonably impressive average cost basis. Ignoring price and buying $20 a week, whether we were at the all-time high or the seasonal low, we've achieved an average purchase price of just $43,034.47. $20,000 cheaper than more than $20,000 cheaper than the current price of Bitcoin. So not too shabby. Of course, we automated our DCA stack a couple of months ago because Strike, who is not a sponsor of the podcast, offered free Bitcoin purchases if they were automated. And so we set up a weekly automated stack of just $20, and that already triggered. That happened about the time I started recording. So we've already made this week's purchase, and we did so when Bitcoin was just a little bit more expensive than it is right now. Bitcoin was priced at $64,918.20, still below $65,000 where Bitcoin had been this afternoon. So our $20 purchased us another 30,808 Satoshis, about 1,200 fewer Satoshis than last Wednesday because, we paid more, and that's the way the cookie crumbles. As I mentioned earlier, when Bitcoin eclipses $100,000 again, we'll be getting, just 20,000 sats or less for that $20. And as Bitcoin continues to go up, the number of Satoshis you're going to be able to purchase, even if you can find someone willing to sell you Satoshis at all, will decrease. So those 30,808 sats bring our stack now up to a total of 12,067,670 Satoshis. It did increase our average purchase price because, again, the price of Bitcoin is about $20,000 more than our average purchase price. So it increased our average cost basis by $55.87. So our average cost basis is now $43,090.34. Still pretty incredible because, we're looking at Bitcoin at more than $64,000 a pop. And so plenty of people already would be calling you lucky if your average purchase price is $43,000. But plebs, that average purchase price will continue to go up as the price of Bitcoin goes up, but slowly because, we've already got 260 purchases under our belt now. So when Bitcoin's 100,000 again or 200,000, our average cost basis is still going to be radically below that. And that's pretty cool. And we did all that by blindly stacking $20 a week without paying attention to price. But to put that into further perspective, when Bitcoin does reclaim the $100,000 mark, our current humble stack of 0.12 Bitcoin will have a US dollar value of $12,067.67, which is a heck of a return considering that we've put just $5,220 US dollars into Bitcoin now. When Bitcoin hits 200,000, our stack, without adding a single extra Satoshi, and of course we're going to keep stacking, but just looking at where we are now, would have a value of $24,135.34. When Bitcoin goes on to set a new all-time high in the $1 million range, whether that happens next cycle or whether that happens after 2032 or whether that happens, in whenever, eventually, I firmly believe that will happen. It has to happen. I firmly believe that Bitcoin is an all or nothing proposition. Either it goes to zero or we see hyper-Bitcoinization. And on the path to hyper-Bitcoinization are numbers like 1 million. And when Bitcoin does hit 1 million, our humble stack will be worth a staggering $120,676.70. We're talking Hillary Clinton and Nancy Pelosi style returns for just $5,200 US dollars. But of course, it gets better. OG Cypherpunk Adam Back, he said that he believes by the 2032 halving, Bitcoin will reach $10 million a coin. Obviously, 10 million is just a drop in the bucket on the way to taking over the entire global monetary system. Everything divided by 21 million Bitcoin, as they say. But at 10 million, our stack will be worth more than $1 million. $1,206,767.00. Maybe that's not generational wealth. Depending where you live, it's generational wealth. Most of the world lives where $1,200,000 would set you up for life. But if you're here in the United States, maybe that's not the case for you. If you're Michael Saylor, it's certainly not the case for you. But then again, if you're in the position where $1,200,000 is not life-changing for you, you're probably putting away more than $20 a week. And so your stack is even larger. Lastly, who can forget Fidelity? We spoke about Fidelity with Michael Saylor's new banking index, but Fidelity made the prediction back in 2022 that they believe by 2038, one Bitcoin will be worth more than 1 billion US dollars. Highly possible if we see Bitcoin continue to succeed in replacing gold, for example, and then replacing real estate and other traditional investments as the ultimate store of value, as the ultimate way to protect your wealth. When that happens, when Bitcoin hits the $1 billion mark, whether that's in 2038 or whenever that happens, our humble stack would have a staggering fiat value of $120,676,700 US. And now I know most of you listening out there, maybe Michael Saylor, he with his billions of dollars of Bitcoin would poo-poo $120 million. But for me, $100 million, $120 million, I would consider that generational wealth. I'm assuming most of the people listening to this podcast would as well too. And plebs, we will have gotten there by converting just $20 a week into Bitcoin, stacking now just $5,200 worth of fiat and converting them into Satoshis. All right, as usual, before I wrap, I want to take a minute to remind you to follow the podcast on X. On X, we are at BTC Bulletin Pod. That's at BTC, the letters BTC Bulletin, and then pod is in short for podcast. And I post things from time to time on X that I talk about in the podcast. So if you want to follow along, if you're listening to audio only, which is currently the only way to listen to this podcast, it's helpful to see some of the visuals I'm talking about, and I usually post those on X. I don't spam you. I only post maybe one or two things a week. I post the link to the latest episode and maybe one or two things that I talked about in the episode. So I won't spam you, but it will go a long way to help promote the podcast in that algorithm, to help more people find out about the podcast. And of course, most importantly, I love nothing more to hear from our fellow Bitcoiners and the listeners to this show. And along those lines, my DMs are open, and I do reply to every DM I get from a show listener. Of course, if you're not on X and you want to reach out and say hi, you don't have to send a boost. You don't have to send a shout out. It's cool if you do. We'll read it on the podcast. But you can also send a humble email. The email for the podcast is bitcoinbulletin@protonmail.com. That's bitcoinbulletin@protonmail.com. And of course, I reply to every email I get as well as every DM. But most importantly, I will see you next week and every week as we keep building that future, as we keep converting just 20 humble US dollars into Satoshis, as long as there are people foolish enough to sell us Satoshis for money that other people print out of thin air. But until that time, keep on stacking those sats, you sexy sat stackers.